All right, let's get right into this explainer. If you've been watching the currency markets lately, you know the euro to rupee exchange rate has been an absolute roller coaster. We're essentially watching a classic macroeconomic tug of war right now. It's being driven by clashing central bank policies, wild swings in energy markets, and a rapidly shifting geopolitical landscape. So today, we're going to demystify all of that and figure out exactly what July 2026 holds for this crucial currency pair. We've got some heavy economic data to cover, but we'll move through it methodically. First, we'll cover the current state of the EUR/INR. Second, geopolitics and oil prices. Third, the central bank policy clash. Then we'll dive into institutional forecasts, outline our July 2026 currency scenarios, and wrap things up with some strategic exchange recommendations. Okay, Section 1, the state of the EUR/INR. Let's establish exactly where this currency battle stands today. Anchor this number in your mind, 179.99. We are sitting right around 108 rupees per euro. This is our current stalemate, and it's going to act as the baseline for everything we discuss. To really understand why we're stuck here, remember that this cross rate is basically a mathematical equation, right? It's the euro to dollar rate multiplied by the dollar to rupee rate. At the moment, the euro is under serious pressure against the dollar, trading near a one-year low, while the rupee has actually stabilized after some recent interventions. The result of those two forces colliding? This exact tight consolidation point at 107.99. And man, it has been a turbulent spring getting to this point. Think back to May 2026. The euro surged to an all-time high against the rupee, hitting a massive 112.373. But then a series of dominoes fell. The European Central Bank hiked rates in June, which oddly enough coincided with a temporary West Asian ceasefire late in the month. That ceasefire really cooled off the market panic, leading us directly into this tight consolidation band between 107.90 and 108. It's been a massive, massive correction. Moving on to Section 2, geopolitics and oil prices. You really can't talk about the Indian rupee without talking about crude oil. India is incredibly reliant on energy imports, so global energy dynamics are a massive weight pulling the rope in the rupee's favor right now. The recent announcement of a 60-day negotiating window and an interim ceasefire between the US and Iran, absolute game changer. It normalized tanker traffic through the Strait of Hormuz almost overnight. Because of that, Brent crude prices plummeted down to that $72.5 to $74 range. For the rupee, this is a massive sigh of relief. It significantly reduces imported inflation pressure, narrows the trade deficit, and effectively gives the rupee the muscle it needs to pull the euro down from those May highs. Which brings us to Section 3, the central bank policy clash. This is where the plot really thickens. On one side of the ring, you've got the European Central Bank. They just executed a 25 basis point hike in June, bringing their main rate up to 2.40%. But their growth projection is a sluggish 0.8% for the year. That just screams stagflation risk. That dangerous combo of high inflation and stalled growth. On the flip side, the Reserve Bank of India is holding steady at 5.25%. Now, they did downgrade their growth slightly, but we're still looking at a robust 6.6% GDP projection. The RBI is clearly signaling that stability and inflation control take precedence over adding more stimulus. This gives the rupee a very strong nominal yield advantage. Investors are seeing a stark divergence here. Europe is hiking into an economic slowdown, while India is comfortably holding steady in a growth environment.
All right, Section 4. Institutional forecasts and opinions.
So, with these forces pulling in totally opposite directions, what are the institutional heavyweights predicting for Q3? Well, what's fascinating about these projections is the sheer range of expectations. There is zero clear consensus, which just goes to show how volatile this pair really is. MUFG and ING are leaning slightly bullish on the euro, predicting a climb back above 109 or 110. They're anchoring those forecasts on a potential Eurozone economic recovery and German fiscal support. But then you have BNP Paribas and the Money Hop consensus anticipating a much tighter or even downward correction. They expect the ECB to stay on hold while the rupee stands its ground. It's a genuine split in the market. And I think this perspective from Societe Generale absolutely hits the nail on the head. Why is the rupee holding its ground so well against a historically strong euro and a broadly strong US dollar? It comes down to debt portfolio inflows. Foreign capital is actively flowing into Indian debt markets, heavily attracted by that stable 5.25% yield we just talked about. These inflows act like a powerful anchor, actively offsetting the broader strength of the dollar and the euro and keeping our 108 baseline fully intact. Let's jump to Section 5, our July 2026 currency scenarios. As you know, forecasting isn't about having a crystal ball. It's about mapping probabilities based on hard data. When we synthesize all this macroeconomic data, we get three distinct scenarios. Right now, the data heavily favors a holding pattern, a massive 65% chance that our current baseline remains steady. Beyond that, we're tracking a 25% probability of a bullish euro scenario, and just a 10% chance of a bearish euro, meaning a surprisingly strong rupee. Let's unpack the two biggest probabilities. In our most likely baseline scenario, that 65% probability, the status quo basically holds. The 60-day interim ceasefire in West Asia stays intact, keeping oil prices stably trading between $70 and $75 a barrel. The ECB stays on pause after their June hike, and that sweet foreign capital keeps flowing into India. If this plays out through July, we'll stay locked in a tight consolidation band, gently fluctuating between 107.20 and 108.80. Week on week, you can expect early stability in the first half of the month, maybe some minor tightening late month, but averaging out right around 107.95.
However, we always have to account for risk. The 25% bullish euro scenario triggers if those geopolitical negotiations break down, if localized shipping disruptions start back up, and energy prices spike above $85 a barrel. India's trade deficit is going to widen immediately. At the exact same time, the ECB might be forced to signal even more rate hikes to fight off renewed energy inflation. If we see that environment, the euro suddenly gains a sharp advantage, potentially breaking out of our current consolidation and pushing the rate quickly back toward the 109.50 to 112 range.
Finally, Section 6, Strategic Exchange Recommendations. So, what does all this mean for your wallet or your business operations this month? Let's break down the action plan. If you're a commercial importer dealing with Europe, this current 107.20 to 108.80 baseline is your prime execution window. It gives you some much-needed stability. For retail remitters or students sending tuition money to Europe, my recommendation is to lock in these rates right now. You really want to execute before this 60-day ceasefire window closes, and certainly before we see any unpredictable winter energy spikes. On the flip side, if you're an Indian exporter selling into Europe, patience is going to be your best friend. You might want to hold off and capitalize on potential pullbacks if the rate manages to creep back above 109. As we wrap up this explainer, I want to leave you with a crucial question to ponder. We've established that this 108 rupee to the euro rate is a really delicate stalemate, and it's highly dependent on a temporary 60-day diplomatic window in West Asia. But the clock on that ceasefire is actively ticking down. When it hits zero, which domino falls next? Will negotiations succeed and cement the rupee's stability, or will a sudden breakdown shatter this calm and send the euro soaring again? Make sure your strategies are locked in, because in the currency markets, calm is almost always just the precursor to the next storm. Thanks for joining me on this deep dive, and keep a very close eye on those energy markets.